We were talking, John, about economic data, why they matter. How closely, to what degree do you as market strategists care whether the Fed hikes in September, whether the Fed holds off until 2016? At this point, does it matter that much?
It does. I mean, the markets obviously are paying attention to it, so we have to pay attention to it. But our view for some time has been that tapering was tightening, right? So we're 12 months in, 18 months into this tightening process. So whether they tighten in September or December, not a big deal in the big scheme of things, but the market will pay attention to it, so we will. But you've seen the yield curve flattening. We're sort of, in the mid stages of this tightening process. So we actually take the view that the actual hike itself could be a good thing for the economy and a good thing for the markets versus all this nervousness around when is Yellen going to hike and what color sweater is she wearing today.
And what if it doesn't happen in September or December? What is that, and how is that going to change your view?
That would change our view on economic growth, right? Yellen has been very clear that the first quarter weakness we saw was transitory. They expect to pick up in the second half. If we don't get that pickup, they probably delay the hike, and that probably has a negative outlook. That means a negative outlook for the U.S. economy, and that's bad for stocks. Probably a little bit better for bonds.
But we're talking about, this shouldn't matter one iota to people who are allocating for the long term, the medium to long term.
Absolutely not. It shouldn't matter at all. It's one hike, it's 25 bips. But I'll give you the positive spin on it, right? A, potentially a stamp of approval on the economy. So the market's like, all right, the Fed thinks the economy's doing well enough to hike rates. B, all those...
Or they just want to have some gas in the tank when they need to cut again.
It could be that, but I would sorry, Eric, but I'd say that's the cynical view, right? But I also think that all those savers out there that have been getting nothing in their savings accounts and demographics, right? We have a lot of older people in our society that are relying on income finally get 25 bips. No one's running a victory lap over 25 bips, but the implication is that that turns into 50, 75, 100, and so it could be a boost to consumer spending. So we actually think that the hike could potentially be a positive for the markets.
Dollar strength going to continue on?
It will, but not at the pace we saw last year. The rapid appreciation of the dollar actually did the Fed's job for them and likely pushed out the hike to later this year. So we expect it to continue strengthening, but not nearly at the pace we saw last year.
It's your job to look at markets across the globe.
Yep.
Where is their value?
We think that the fattest pitch in the market is in Japan, right? You've got cheaper valuations than you have in the U.S., stronger earnings growth, very aggressive monetary policy, somewhat aggressive, sometimes not aggressive fiscal policy. But this third arrow that Abe's been talking about for the past 2 years, which everyone's been having difficulty defining, is, we think, coming through now in corporate governance, right? So they're encouraging companies to finally give back to shareholders. So the Japanese market is crushing it this year, doing very, very well versus the U.S., versus Europe, and we think that trend can continue for the foreseeable future.
So you expect to see other Japanese companies following the lead of Fanuc, for example?
Yes, absolutely. We think that's going to be a trend. I mean,
big victory for down low.
Big victory, I was going to say. Yeah. I mean, we've never seen that before.
It's been a very, very long time. So they've created a shame index, right? You need outside directors on your board. You need to return value to shareholders, whether it's through buying back shares, increasing dividends, doing accretive deals, things like that. I mean, people have this view for a long time that Japanese companies were sort of fuddy-duddy, sitting on their hands. There's a lot of cash on balance sheets over there. We always talk about it from a U.S. perspective, but the cash on balance sheets in Japan is massive, and consumer balance sheets as well. So we think there is a long-term positive trend going on in the Japanese equity market.
You mentioned earlier, savers have been starving.
Yep.
That has pushed so many investors into the credit markets, corporate bonds, high yield, distress. Are you concerned at all that we're approaching bubble territory?
No, I wouldn't use the term bubble because I think it implies that the bubble has to burst, right? I don't think we're quite there yet. You're seeing some worrying signs on corporate leverage. Leverage is going up, but at the same time as leverage going up,
Covenant-light deals?
Covenant-light deals are very, very high. You're also seeing interest coverage go up at the same time, which you never see. Right? And the reason for that is because of low interest cost on bonds. So I think at some point we're going to want to take that trade off. We're currently overweight high yield bonds, but we're not there yet.
Take that trade off and go where? Into plain vanilla equities?
Oh, we might go back into equities. I mean, it really depends what's going on at that time. But I think high yield still has some legs left, especially with interest rates where they are, at least for the next 6 to 12 months.
John, we thank you very much for spending time with us.
Good seeing you guys.
Great having you on.
Jon Mackay of Morgan Stanley.